Glad to have you back. We're on Module 24 of the Series 65-66 session from Series 7 Specialists. And going to wrap up this section and then move into analysis, recommendations, and suitability. But for right now, let's wrap up with where we left off last time, which is at towards the bottom of page 36, talking about life insurance. Now, life insurance, really not going to be a whole lot on this because it's not the life insurance exam. Again, you need to have just a general working knowledge of the terminology should be okay for you. The first is term insurance. Term insurance, as long as you pay for it, it's there. Once you stop paying for it, it's dropped. If you don't die while you're paying for it, you're not going to get anything. It's the term that they no pun intended, but the phrase that they use is that you're renting insurance. You're renting protection on your life. And that's all it has is a death benefit. That's about it. Okay? You also have whole life, which builds up cash value over time. Now, the thing about whole life is that you start out overpaying, and that difference then is going to go to cash value. It's a way simplified view of it, close enough for our purposes, okay? So that extra payment goes to build some cash value for you that then you can borrow against. It can be there, and what it's going to do eventually is that it's going to pay the extra premium that you don't pay out of pocket once you get to a certain age, and what you should pay just for the pure protection is more than you are paying on a level payment plan. And you've got all kinds of variations on this, that like the universal life. Doubt seriously that you get into universal life on this test, okay? But in any event, whole life and of course the universal life will build up cash value over time, and you'll have something that again you can borrow from it. It will have a level premium. It doesn't really care how old you are. It's going to have the same premium going forward. And then finally, variable life. What we did up here before was we drew that circle and we put that pot on the middle of it that was marked Bob. And Bob, in his separate account, he had a bunch of choices of what he could invest in. And he assumed the market risk for those investment choices. It's pretty much the same thing, except that instead of being an annuity, it's a life insurance policy that has a death benefit. And again, the differences go way beyond that, but for this test, that's really about all we need to know, okay? Is that variable life, Bob can invest in stocks, bonds, whatever he wants to invest in, as long as it's offered there inside of his separate account as one of his investment choices. So it allows for the owner input into the investment of the cash value that he's building up. Then employee stock options. Now these as opposed to listed stock options, okay? So they're not traded. They're something that I grant to certain employees. A big difference between the two. So be sure to read your question carefully. I keep going back and back to that. But that's one of the things. In fact, I'm just going to take a second here and say again what I believe I've said before. If not, I should have, and I probably need to say it again before it's all over with. As you take practice exams, look at why you miss what you miss. That's critical. Because if it's something that the easiest thing is, I don't know the material. I just guessed. That's easy. Find the material, brush up on it. But then the ones that are, you've got to get these, okay? It's a tough test. They structure it to be hard. And so you've got to get the ones where it's, oh man, I misread the question. Oh, I didn't see that except. Oh, I didn't use process of elimination right, because you know what? I eliminated B, but then I'll be darned if I didn't put it right back in. Okay, you see what I'm getting at? You've got to, it's not content related, but it is related to you passing the test, and that's our goal, is to pass the test, okay? So look at why you miss what you miss, and start paying attention to those words that turn things one way or the other. Like I say, analyze what went on. And in fact, one of the things that I want you to do when you take a practice exam is to do what we talked about earlier. Once you get finished with it and you're comfortable with your answer, don't question your answer, But go back through, read over it again and question the question. Did I see all the words? Did I get the idea that they were going for? Did I miss that not? Did I miss that accept? Did I miss the investment advisor or the word agent to say that it's at the state level in a broker-dealer environment? Do you see what I'm getting at? All those things. Why is that important? Because we're both in the same boat. We both want to see you pass your test. All right? And I'll tell you what, our sponsors, they're in the same boat with you. They want to see you pass your test, then they want to see you succeed as you go into production. That's why we've chosen the sponsors that we have, okay? So that's why I really encourage you to visit our sponsors. All right, but let's go ahead and get back because we have a lot of territory to cover. Employee stock options. We have non-qualified stock options, or NSO. There's a bargain element. Because if the stock is trading at 10 and I can buy it at 3, I've got a $7 bargain element. All right, that's going to be reported as current income for me when I exercise the option because it's a non-qualified option. If it's an incentive stock option, then the bargain element is reported as long-term capital gain, but I've got to do certain things to make it long-term that are more than just holding it a year and a day. Okay? A stock has to be held 2 years after the grant and 1 year after the exercise. So if as an incentive stock option, I'm given that option today, then I have to wait 2 years from today, okay, so 2 years after the grant, or if I exercise it at a year and a half, tack another 6 months onto that because it's got to be a year after the exercise. And if I do that, then that's long-term capital gain, gives me a significant tax advantage on incentive stock options, or ISOs. All right, so that's about it for that. Let's go ahead then and start in on the next section. Investment analysis, recommendations, and strategies. And we start talking about quantitative methods of analysis. You don't have to be a mathematician to pass the test. You do need to, it's much more important to understand what's measured and generally speaking how it goes about measuring something than it is to be able to use your calculator to find this, okay? Now, one of the things that we talked about, and we said we'd revisit it, is the idea of a zero coupon bond. A zero coupon bond because it holds all factors constant, okay, except what you bought it for, we know what it's going to be worth, and when. That's it, okay? We actually have kind of a laboratory environment for that. So we touched on it earlier. We'll come back and revisit that. One of the most important things to keep in mind is that first point, the time value of money. Okay? Compound interest is a classic case of the importance of the time value of money. Because if I plug it back in, if I leave it in over more time and plug it in again and again and again, it's going to be worth more and more to me. One of your biggest tools is the rule of 72. Okay? A lot of these tools, they take just really fairly sophisticated calculations to figure them out exactly. This isn't a math test. All right? So don't worry about exactly. Try an estimation. Just try to eyeball something and get close, because many times close is close enough, especially on a test like this or on your Series 6 or Series 7. All right, so anyway, what we've got is that the rule of 72, it tells us how long it will take money to double. So if I have a compounded interest rate of, let's say, 6%, then it's going to take me, what's 6 into 72? 12 years to double. If I want to shorten that time frame up to where I can double my money in 10 years, then what's 10 divided into 72? 7.2% compounded is what I'm going to have to get. Rule of 72. What if I wanted to quadruple? Well, let's see, I double it once, I double it twice. So if it takes me, like I say, 6%, 12 years to double, it's going to take me 24 years to be 4 times as much. Okay? Well, what if I want it to triple? I'm going to be in between the two. So give or take, it's going to take 12 plus 6. Give or take, it's going to take 18 years. See if there's something that's close to 18 years. The others are going to be just all over the board. Okay? Close is close enough. And use that because, like I say, you can use it forward or backward, either way. That's going to be one of your most important tools, is the Rule of 72. Because it gets you great estimations. All right? So anyway, present value, net present value, future value, internal rate of return. With the exception of net present value, let's go ahead and knock it out real quick. Because net present value takes the idea of present value and it goes one step further. All right? And so it's something that we'll need to look at here in a second. But let's redraw that zero coupon bond chart that we had so that we can work with it. We said that a zero coupon bond, since it paid nothing as we go, that what happens is that we have to buy it at a discount. So there's the discount price. And eventually at maturity, it's going to be worth X number of dollars. And not the best drawing in the world, but that's okay. Okay, we can live with it. There we go. And so what happens is that to keep it simple, you can just draw a straight line. It works. All right. Really, what happens is that it's kind of a exponential curve like that, because as that time passes, you're getting more and more compounding kicking in. Okay, as it accretes or accrues that value. All right. So basically, we said that this period of time from here, when we bought it, to maturity, that period is also the duration of the bond. That this is its present value, the discounted price. That this is its future value. That the percentage, because everything goes on in here, this is also the true rate of return to maturity, or the internal rate of return. Okay? So like I say, all of those factors, because there are no variables on a zero coupon bond, assuming that we hold it to maturity, all right, then that's those things they're easy to talk about. So let's come back and pick up the present value. Like I say, given a goal of X number of dollars, a Y% interest rate for a certain number of years, how much is it going to take today to reach that goal? All right, or dropping down to future value, we know how much we want to have, okay? Or that's what it's going to grow to if we have all these parameters in place. That's our future value. Net present value is something that's often used in buy or build decisions. What we'll do is that we'll look at the present values of an investment over a certain period of time. So we think we want to build a manufacturing plant. Well, how much money can that produce us? Well, we think that it'll produce us X number of dollars in profits per year. Great. What we'll do, how much is next year's profit worth today? We discount it back and we get that present value. Oh, and what about the following year? Well, we discount it back a little bit further. And the next year, yet further. And you see, we just keep on taking them. And then we wind up with a sum of, so we're going to look at it for a 20-year life. We'll have 20 of those present values. We'll add them up. And then we'll say, okay, let's see. The sum of those is $400 million. And it's going to take us $180 million to build it. Hey, this sounds like a good deal to me. Okay. Or we say, the sum of those is going to be $210 million. And it's going to cost us $230 million to build it. Why bother? Let's continue to buy the stuff that we're buying. We don't need to build a new manufacturing plant for that, because the net present value is not going to exceed the cost. The cost is going to be more than what we're going to get out of it. Okay, so often used, like I say, in manufacturing decisions to determine new plant, new equipment that we want to buy, and justify that. And a positive net present value is desirable. Okay, we talked about future value, talked about internal rate of return, talked about current yield, which is current is just cash on cash. All right, so that if I have an investment that's throwing out $100, and I had to pay $1,000 for it, then I'm getting a 10% current return. But if I had to pay $2,000 for it, same $100, I'm only getting a 5% current yield. You may have to figure current yield, but that's simple. Just what's the interest that you get divided by how much money that you had to put in. Current means right now. So how much money am I getting right now in terms of cash every year, and divide that by how much money did I have to pay right now. That's your current yield. Okay? The yield to maturity, it's going to reflect what the market is demanding from similar quality and similar products, similar debt securities, or actually, even though there's no maturity on it, preferreds will, since they act in concert with the bond market, preferred stocks will pay about what the market is demanding. And similar maturities priced at a par or at a discount, because if the marketplace is demanding 7% and I have a 2% bond, hey, I've got to discount it down to where all factors coming in, this appreciation plus the $20 a year that it throws off in current yield, okay, all that's going to wind up being the 7%, I think I said, that the marketplace is demanding. By the same token, if the marketplace is demanding 2% and I've got a 7% bond, well, hello, I can request a premium for that, and as that value deteriorates over time, see, that's to the new investor, he's going to wind up with a 2% rate of return to maturity. So that's your yield to maturity. You won't have to calculate yield to maturity. All right? If you do, if there's a question about it, it's not a calculation question. Okay? It's more just a conceptual question. And so look at your answer choices that you have. And remember that we talked about that little teeter-totter way back when? And when we did, we said that whether at par, a premium, or a discount, your price is over here, your coupon rate is right here, or the stated rate on the bond, then you have your current yield, your yield to maturity, and then also if it's at a premium, you'll have a yield to call. We won't worry about that. Okay? What you'll need to do is that you'll need to know that if it's a discount bond, calculate your current yield. And then you know that the yield to maturity is going to be higher. Or if it's a premium bond, calculate your current yield. Okay? And then you know that your yield to maturity is going to be lower. And just do it that way. Okay? Because, like I said, you should be able to do, to figure what the answer is. You need a letter, not a number. Okay? So go for the right letter. Then yield to call, again, it's comparable to yield to maturity, except that if the bond is trading, if bond's trading like this at a discount, then that means compared to what the market rates are, the company has cheap finance. That bond ain't going to get called. That's like you having a 2% mortgage when prevailing rates are at 10%. You're going to make minimum payments on that thing, okay? But, okay, if the marketplace is only demanding 2% and you're paying 10, what are you going to do? You're going to refinance. Same thing with a corporation, the municipality, and so the yield to call is going to be on out here. It's going to be the lowest of all of these. Okay? And of course, yield to call is not meaningful up here. There we go. It's an equal sign. There we go. Just not meaningful if you have a discounted bond. But there's our yield to call. Again, very similar, except that we're pretty sure that this bond is going to be called for redemption early. Now, our expected return. Okay? This is projected returns based upon the risks that we take, where the series of P, or the probabilities, are achieving certain returns. Okay, so in the first year, if we expect a return of 2%, the next year we expect a return of 3%, the next year 4%. Okay, then if there's a probability of getting 2%, the probability is 20%. Would take 20% times 2%. If you've got a 60% probability of a 4% return, 60% times 4%. We have a 20% probability of a 5% return. Take 20% of 5, just add all those together, and that's our expected return. We just, again, take the probabilities of X, Y, and Z and just returns, and we add those together. And that's what we can reasonably expect, because it just kind of averages out, normalizes out the risk factors that we're looking at. Okay, total return is going to include earnings from everything, dividends and or interest, capital gains, other distributions, like I said, whatever it may be. If it's principal, though, not going to be included in that, but total return is going to include all of those things: appreciation, depreciation, if we have a bond that's bought at a premium. All right, so the total return is going to include all of that. Holding period return and annualized return. Now, this is probably, in a session or two ago, we talked about options and selling options for income. And what an option seller really wants is for that option to expire worthless. I had one situation where I actually sold some call options against stock that I own, a covered call. Okay, and I made like 1.5%. I was just really, really excited, because 1.5%, I did it in a month. That's an annualized rate of return. If I could have done it every single month, I would have made 18%. That's cool. Okay? So now, here's one of the keys on period return and annualized rate of return that you'll probably need to use, okay? And that is that if I have a period of 1 year and my period return is X, my annualized rate of return is likewise going to be X. But the thing is that if I have a holding period that's less than a year, and I still get X% over that shorter holding period, then my annualized rate of return is going to be greater than X, because what am I going to do? I'm going to assume that I can make it for this period and that period and that period. You guys get the idea. But on the other hand, if I have a holding period that is longer than a year, then my annualized rate of return is going to be less than X, okay? Because it took me this long to make X%. Well, that's way over a year. So what did I make from here to here? Okay, not the whole X%, so it's going to be less than X if my holding period is longer than a year. So greater time period means lesser rate of return. Lesser time period means greater rate of return once we annualize it out. Equal, of course, is going to be equal. All right, so anyway, this looks like a pretty good place for us to take a break. Yeah, it really is. So we'll go ahead and come back and pick up on some of these then after our break. Thanks for being with us. Really do hope that that you pass the test, that you give us good feedback and what have you. Anything that we can do to make it better, let us know. Appreciate it.